Hi guys, welcome back to my channel. My name is Bhanushali. I'm a civil engineer by profession and I have a keen interest in finance. In today's topic, we are going to discuss about should you buy or rent a house in Canada. Renting is throwing away your money. The only way to build wealth is buying a house. Sounds familiar, right? You might have heard this debate a thousand times, but here's the truth. Neither side is 100% right. So, in today's video, I will break down the real numbers. What are the hidden costs? So that you can make smarter decisions for your wallet. If you are watching this, you are probably stuck between FOMO on Canada's wild housing market and the fear of signing a 30-year mortgage when the rates are sky high. I get it. Let's cut through the noise. In Canada, the average housing price is 720K and the rent just hit $22 per month. So, is buying a house is good idea or renting is better? To understand this, I will divide this topic into three parts. First, we'll run through the math of buying versus renting. Second, we'll understand the myths around buying and renting. And third, we'll figure out if you're ready to buy or not. Let's take an example of this house, which is priced at 620K in Ottawa area. This house is three bed, four bathroom house. It's freehold townhouse. For rent, I have found other property which is similar. So I found the rent as 2650 per month. I've entered all this data in New York rent versus buy calculator. So you can see that I've added the home price is 620K, monthly rent is 2650. How long do you plan to stay? Usually in Canada, people, as per the Globe and Mail report, people move after every 7 years, 7 to 10 years. I have added 8 years. What are the mortgage details? As per 2025, the current mortgage rates are for 3 years fixed is 4.89 as per National Bank data. I have added year 5%. I've had a 10% down payment, which is 62,000. The length of the mortgage is 25 years. Private mortgage insurance ranges between 2 to 4%. I've had a 2%. And this calculator is really good. We can add the future advanced options as well, which includes what does the future hold, like how and what will be the annual growth rate for a house. So I have added 3%. What will be the rent growth rate? I've added 3% as well. And investment return rate. So usually the S&P 500 uh, annual growth rate for past 30 years comes around 10%, but we I have accounted for inflation as well, which is usually 3%, so I added 7% investment return rate. If I just add 10%, you can see how the numbers change quickly. So you can see renting, it shoots for around 50,000. So for realistic purpose, I've added 7%. Inflation rate is 3% here. Also, I have added taxes, which are like property tax rate. I have added 1.35, marginal tax rate 20%. Closing cost for the house, which includes 5% cost of buying the home, 6% cost of selling the home. I have added maintenance fee. There is a general thumb rule for maintenance. It's 1% of the total house price. So I have added 1% homeowners insurance, which is 0.55, monthly utilities, which includes gas, Wi-Fi, hydro, water. I have added 200. You can add more here. I've said 200 to 250. And in rent, we are just paying the security deposit, which is 1 month, and renter's insurance. So here you can see that if we are just renting this apartment, this townhouse, we can save around $138,000, right? And which is over 8 years. Wait, is renting cheaper? Yes, because when you own a house, you are losing on a stock market gains, which is typically 7 to 10%. That 62K invested for an average 10% year on year return for 30 years, that 62K could grow up to a million. There is another rule explained by Ben Felix, the 5% rule. I will add his YouTube link in the description, which states that if rent is less than the 5% of the home value, you should rent, and the difference you should invest in the stock market. For an example, If house value is 1 million, 5% is 50,000. If you divide that 50,000 by 12, so the monthly amount comes to 4166. If the rent is less than 4166, then you should rent, and the difference you should invest. Let's take another example. In Halifax, if the house value is 300k and 5% of this 300k is 15,000, and if you divide that 15,000 by 12, per month cost comes down to 1250. And if the rent is $1,500, then you should definitely buy. Now let's understand the myths associated with renting versus buying. Myth number one: renting means you are paying landlord's mortgage. Wrong. Landlords they charge the market rates, not the cost plus profit. If they were able to do that, they could have done like 50% profit, but they can't. You are paying for housing, servicing, and maintenance. That's a valuable service. Second, renting is throwing away your money. You are paying for the shelter and avoiding any maintenance cost that homeowners may face. It's like paying for service like anything else. And third, buying builds equity. Building equity takes time. Now let's look at this amortization chart. In this chart, I have used a same amount as per our initial example, which is the initial house price we look at was say 620k. So I have added 10%. I have removed the 10% down payment, which is $62,000. So the remaining is the loan amount, which is like 5,58,000. Loan term is 25 years, and interest rate is 5%. And based on that, you can see that yeah, at the 12th year that's a break even point, and until 12th year your mortgage is going towards the interest and not the principal amount, and after the 12th year it's going more towards the principal amount. So building equity, it takes time. In addition to equity, there are costs associated with taxes and financial repairs, so you should take into account those as well. So buying should be a financial decision, not an emotional one. Lastly, should you buy or rent? But before buying, you should ask yourself these two questions. First, can I afford to buy this house based on my income and debt? There is a rule which is called 28 by 36, which states that your housing cost should be less than 28% of your gross monthly income, and your total debt should be less than 36%. Second, have I saved 20% down payment? While it's not mandatory to put down 20%, but it's important to develop saving habits before getting a mortgage, as it's really crucial. If you buy, you should think long term. When buying a house, choose one you can see yourself living in for many years, because this will help avoid losing money on fees and costs when you move frequently. Second, be skeptical of real estate advice. Many people giving home buying advice benefit when you buy from them. Real estate agents, mortgage brokers, and others often encourage you to buy quickly. Consider their motivations. Realistic expectations for home value. Don't expect your home value to significantly outpace inflation over the long run. Historically, real estate returns haven't always been high as some believe. Consider the cost of tied up money. Remember that money you put in your house could be used for other investments. Think about the potential returns you are missing out on having by your capital locked in your home. Home improvements are for living, not investing. Expensive renovations are generally for enjoyment and comfort, not to significantly increase the financial value of your home as an investment. And if you rent, you should keep in mind that saving is essential. To build wealth like a homeowner, you must be a disciplined saver. You need to consistently save and invest the money you don't spend on home ownership costs like mortgage payments, property tax, and maintenance compared to renting. Be aware of costly investments. High fees, mutual funds, and other products significantly reduce your investment returns over a long time. Choose low fee options. Think of long term investing, not like quick rich scheme. Don't get rattled by short-term ups and downs in the financial markets. Invest smart, not risky. Having a well-thought investment plan and stick to it. Avoid get rich quick schemes or overly risky strategies like day trading. A smart approach to invest in a diverse mix of low-cost index funds that track the overall market. Be comfortably aggressive. For long term growth, include a significant portion of stocks in your portfolio, but ensure it's globally diversified across many companies and sector to manage risk. In future videos, I will discuss about which stocks to pick and what to look, how to fundamental analyze the stocks. But finally, my personal advice, I would say, be take a hybrid approach. Buy a primary home that you can afford without compromising your stock market investments because this will offer stability that will avoid the uncertainty of rental agreements. Second, mortgage free retirement. A period of home provides significantly lower housing costs in retirement. Third, emotional connections. Owning a home fulfills emotional needs and provides a place for family memories. Portfolio diversification. Real estate acts as a hedge if stock market returns are lower than expected. Tax advantages. Capital gains on primary residence are tax free in Canada, which can be significant benefit for retirement planning. So, should you buy or rent? It depends. Use the tools I have added in the description and crunch your numbers. And remember, buying doesn't make you an adult, and renting doesn't make you a failure. Do what is right for your wallet and your life. Until then, bye bye. See you in the next video.